Welcome to part 12 of our Financial Statements video training. In this video, we introduce the statement of cash flows, another one of the main financial statements. We also begin a discussion of the statement's first section entitled Cash Flows from Operating Activities. Please print the PDF handout shown below this video as it will be used throughout the training.
Okay, our next handout is the statement of cash flows. And under the heading, you'll see it's the indirect method. There's two methods to use, and I think it's 97% of the companies use this method. And so that's the one we're going to do, and we're going to assume it's a corporation. Notice the heading, the name of the company is shown first, then the name of the statement, which is the statement of cash flows. Some people refer to this as the cash flow statement, so you'll hear it both ways. The official heading is statement of cash flows. And then we show the period that's being covered by this statement. So again, only the balance sheet showed a point in time. This is the second one now that we see that shows a period of time. Now, the reason this statement came into existence is because of the accrual method of accounting. Right? Under the accrual method of accounting, we said on the income statement, here's what we've earned in revenues, here's the expenses that match up or that expired or got used up or whatever. And here's our net income. But net income didn't mean that went in the bank, right? Many small business people say, you know, my accountant said I made all that money on the bottom line of the income statement. Why don't I have any cash in my checking account? Where's all the money? Right? So the accounting profession responded with a statement that lets you know where the money went. So the statement of cash flow tells us what happened in terms of cash, because the income statement does not tell us what happened in terms of cash. Under the indirect method, we start with the net income number. So as we look down the left-hand side of this statement of cash flows, you see first in bold print, cash flows from operating activities. And then the bottom, halfway down the sheet is cash flows from investing activities. And then lastly, cash flows from financing. So we're going to divide the statement up into three segments, and the first segment starts with net income. So the cash flows from operating activities starts with net income. So our operations, remember, were to sell merchandise and purchase it and operate our stores. So from that operating activity, what happened to the cash? Right? The later one says, what happened to our cash when we were investing stuff or financing? So from just operating our business, what happened as far as cash goes? And we're going to start with the net income. Now, this method might not be the best way. The accounting profession wishes we didn't do it. They want it this way. They prefer we didn't start with net income. They wanted something better, but most companies take the easy way out. So we're going to start with net income. And then we're going to say, some of those expenses on the income statement didn't take cash. For example, that depreciation entry that I wrote didn't take any cash. But yet it reduced my profit, right? Because depreciation expense appeared on that income statement. But the owner didn't write a check for that depreciation. The owner wrote a check when the asset was purchased a long time ago. So maybe the asset was purchased 5 years ago and the owner wrote a big check. That's when all the cash went out. Now in the current year, the depreciation appears for that asset, and the depreciation drove down the net income. But it didn't take any cash. The owner didn't write another check. So we're saying, the net income figure is going to be our starting point, but not all of those expenses required us to pay out cash. So we're going to add back $10,000 for the depreciation because we reduced our depreciation expense $10,000. And so now you see why I separated those SG&A expenses earlier to show that $10,000 so you could tie it in. So the point is, $86,832 is on the income statement, but $10,000 on the income statement didn't go out of the checking account. So we're going to put that back and say we really generated $96,832 so far. Then we go back and go to the next line, and we add back losses on the disposal of assets.